Welcome back to Margin. Guess what? While we were welcoming a new year, our national debt topped $29 trillion for the first time. Now, of course, we didn't need any more bad news, but it's something so important to talk about and to look at the US national debt crisis. Now, many would argue that it's not a crisis as long as we have the ability to pay our interest payments. I believe that this is a crisis, though, because although there are ways to kick the can down the road further, our financial systems are ultimately not working. And these broken systems are infiltrating how the population handles their household finances. The principle of the matter is that you cannot continuously live beyond your means. It doesn't work for a government, and it doesn't work for our own households. Now, from a household standpoint, we cannot increase our own debt ceilings. We don't have the ability to just go out and print more money, and we cannot enact bailouts and other stimulus to get us out of scenarios that we actually created for ourselves. For the most part, though, the population follows the US in how we treat debt. Except our forms of social programs, defense, and urban development are our homes, our educations, and vacations. Our friendly relationship with debt causes us to buy everything we can on credit and to extend terms on that debt out as far as possible so that they have the smallest impact on our monthly budgets. Ponder this for a moment, and while you do, like this episode to support the channel. What would it look like if we actually used the same method of calculating our debt to income ratio the way that the US calculates the debt to GDP? I mean, we don't, but what if we did? It would look like taking your total debt and dividing it by your annual income. Say you have the average household debt, which is currently sitting at $90,460 according to a CNBC report, and the average household income of $67,521 according to the census. So this would mean that the average US citizen would have a debt to GDP of 134%, sitting slightly above, but in line with the current US debt to GDP, which we'll discuss here momentarily. So this is some interesting food for thought. Now, we can't calculate our debt to income this way. We look at our debt payments in comparison to our gross monthly income, which for many, that's a huge sigh of relief because that picture looks significantly better for us as consumers. Now, this looks at how much your car payment is in relation to your monthly income, not how much your car actually cost initially in comparison to your income. So let me ask you a question. Are you operating at a deficit? Now, I don't mean your energy levels. I don't mean socially or emotionally. I mean, are you living paycheck to paycheck? Or better yet, living above your means and in turn operating at a deficit financially, where you're putting your purchases on credit cards each month, where you are eating away at your savings or using some other means in order to fund your lifestyle. Well, you're not alone. In fact, the US is doing exactly this. One of the responses to this has been quantitative easing. Now, you've probably heard that phrase many times over at this point, but the Federal Reserve can print money and buy back US securities by doing so. This increases the circulation of money that stimulates the economy, which to an extent can be good, except for where we are right now with inflation that has risen 6.8% in the last year alone, meaning that the large increase in money supply has created accessibility to greater demand of goods and services, driving up prices that, coupled with the supply chain issues that we've experienced, is a real recipe. As a country, we are saddled with debt, but the picture becomes far more complex under the surface of the $29.7 trillion that the US is in debt. It's scary enough to have an average household debt of over $90,000. But think about this. If the debt was split between 334 million citizens, which is where we're at as of current, this would equate to about $89,000 of debt per US citizen, which should shock you because that's basically doubling the average debt per citizen. Now, I digress, but I thought it was very interesting to look at our debt as a country, look at the debt to GDP, and see how consumers are closely mirroring what our country does as a whole. Now, the interesting part is that our debt is currently owned by a number of different sources. The balance showed a chart derived from the Treasury data that showed that the second largest holder of US debt in the amount of $7 trillion is foreign owned. Now, might I add, that's about a quarter of the debt. Now, this may not be an immediate fear or concern, being that the US is considered very safe. Our debt is considered very safe. But at any point, especially with our debt to GDP rising so rapidly, this could change. And the sentiment of investors into the US could change and make that a much more risky transaction and scare a lot of those investors away. Now, currently, our debt to GDP is hovering around 130% according to Statista. Now, typically, once a country tops 100% of debt to GDP, the country is considered risky. Again, a country's GDP points to its income or economic productivity, and the economic productivity of the US plunged, as you saw firsthand, in 2020 for obvious reasons. Now, leading up to that point, it had continued to be suppressed in comparison to the country's mounting debt. Now, this means that the country more and more was not producing enough to cover the debt that was being produced at the same time. Now, when your debt exceeds your income, this makes you insolvent, or at least that's what the layman terms of this would mean. But as a country, we owe more debt than any other single country. And to put this in perspective, when a country exceeds 77% of debt to GDP, it's a dangerous place for a country due to the rising risk of it not being able to cover the interest, much less the principal payments on that debt. So they're really not able to necessarily make ground on paying down and off that debt. Now, according to Trading Economics, the US averaged a healthy 63.64% debt to GDP from 1940 until 2020, when it surged to more than doubling. Now, although we have a serious issue with our growing debt levels, it's not all doom and gloom. And I found what I researched within the Federal Reserve to be encouraging for this picture. Now, the Federal Reserve of St. Louis stated that when the interest comes due, it can be paid in legal tender. That is by printing additional US or Federal Reserve notes. Now, it follows that a technical default can only occur if the government permits it. The situation here is similar to that of a corporation financing itself and with debt convertible to equity at the issuer's discretion. Involuntary default is essentially impossible based upon this. So even if the national debt doesn't have to be paid back, it still needs to be serviced. The interest expense associated with carrying debt is called the carrying cost. Now, they further continued to explain that a significant amount of debt issued by banks is in the form of insured deposit liabilities. Because insured deposits are safe and because they constitute money, investors are willing to carry deposits at lower yields. As a result, deposits are very cheap source of funding for banks. Now, this low-cost source of funds is used to carry higher return assets like mortgages and business loans. one might say that the net carrying cost of debt in this case is negative. To the extent that the federal government invests in programs designed to enhance productivity, like healthcare and infrastructure, the same thing might apply to the national debt, which is willingly carried by investors at relatively low yields. Now, in layman's terms, this basically means that the US government can print the money it needs in order to meet its obligations. And it compared it to a bank or a institution where we would go deposit savings into that bank. That bank would then have a multiplier that it can utilize in order to make loans. And so it makes loans based on the deposits, the liabilities that you put into the account. It's a liability to them and it's an asset to you. And basically they can make loans, and it allows them to basically finance their operations. Now, going into a new year, think about how you can apply this. Take a look at your overall debt. How much debt are you actually carrying in the form of a mortgage, student loans, healthcare debt, car loans, credit cards, or family loans? There's a myriad of different types of debts, of course, but start with these. Look at how you can ensure that you are not just taking on more and more debt without a plan. Now, I would encourage you to see this as an opportunity to list out all of your debts. Who do you owe? And look at your payoff amounts and your associated payments for that debt, ensuring that those loans are in line with the interest rates of today. Looking at how you can strategically knock out the lowest balance so that you can make some momentum in paying off your debt. But I would say even more importantly, look at how much you are actually paying on a monthly basis to maintain your own lifestyle. Now, you may find this to be a wake-up call and an ability to provide you with a why to drive down these expenses, a purpose around that. Now, there are a lot of New Year's resolutions around debt, including establishing and building credit, debt payoff, as well as aspects like saving to prevent going into debt in the event of an emergency. So being in the first week of this brand new year, use this as an opportunity to change the way you approach your debt as to prevent handling your money the way the US government does. Ensuring that you not only have proper reserves, but that you are deciding to increase your income, reduce your expenses, which in turn gives you margin, something that the US government does not have. If this information is helpful to you, explore the Margin membership, where me and my team will help you take the information you're learning and apply it to your life and your finances. I have built an interactive course that allows me and my team to connect with you and come alongside people like you to help you revamp your finances and build margin into your life. Click the link in the description below if you're interested. We hope to see you there.